Hi, welcome to the fascinating world of economics. Today, we're diving into the wild world of tariffs. These aren't just boring taxes, they're powerful tools that can shape entire economies. They're like the economic equivalent of starting a food fight in a China shop. Imagine the chaos, but with money and goods flying everywhere. Except, instead of mashed potatoes, we're talking about taxes on goods. These taxes can make or break industries, influence prices, and even affect international relations. And instead of a China shop, it's the global economy. Every country is interconnected, and tariffs can send shockwaves through these connections. Buckle up, because things are about to get messy. The impact of tariffs can be as unpredictable as a roller coaster ride, with ups and downs that can leave everyone feeling a bit queasy. Tariffs have been a tool of international trade for centuries. From ancient trade routes to modern-day shipping lanes, they've always played a crucial role. Governments use them for a whole bunch of reasons. Sometimes it's about protecting local jobs, other times it's about gaining a competitive edge. Sometimes it's to protect their own industries from foreign competition. This can help local businesses thrive, but it can also lead to higher prices for consumers. Other times, it's to punish other countries for not playing by the rules. This can lead to trade wars, where countries keep raising tariffs against each other. And let's not forget the good old-fashioned desire to raise some extra cash for the government coffers. Tariffs can be a significant source of revenue. Whatever the reason, one thing's for sure, tariffs are a big deal. They can influence everything from the price of your morning coffee to the stock market's performance. They can have a ripple effect throughout the global economy, impacting businesses, consumers, and even the stock market. The effects can be far-reaching and long-lasting. And lately, no one's been wielding the tariff hammer quite like the United States, especially when it comes to China. The trade tensions between these two giants have been making headlines and shaking markets worldwide. So, what exactly are tariffs? This is a question that often comes up in discussions about international trade and economics. In the simplest terms, they are taxes imposed on goods that cross borders. These taxes can affect the price of goods and services, influencing consumer choices and business decisions. Think of it like this: every time a product wants to enter or leave a country, it has to pass through a customs checkpoint. At this checkpoint, officials determine if a tariff needs to be applied. And just like you might have to pay a toll to cross a bridge, those products might get slapped with a tariff. This toll, or tariff, can vary depending on the type of product and the country it's coming from or going to. There are two main types of tariffs: ad valorem and specific. Each type has its own way of being calculated and applied. Ad valorem tariffs are calculated as a percentage of the value of the goods. This means the more expensive the item, the higher the tariff. Imagine a fancy Italian leather handbag worth $1,000. This is a prime example of how ad valorem tariffs work. If the US slaps a 10% ad valorem tariff on it, that handbag just got $100 more expensive. This additional cost can affect consumer behavior and sales. Specific tariffs, on the other hand, are a fixed amount charged per unit of the imported good. This type of tariff is straightforward and easy to calculate. So, if the US decided to slap a $5 specific tariff on every bottle of French wine, each bottle would have an additional cost regardless of its price. Well, let's just say those Bordeaux nights might get a little less frequent. Tariffs can have a significant impact on trade, affecting everything from the availability of products to their final cost for consumers. Trump's tariff hammer falls on China. Now, let's talk about the big kahuna of tariffs, the ones imposed by the US on China. Back in February 2025, President Trump decided to make good on his promise to get tough on trade with China. He imposed a 10% tariff on a whole bunch of Chinese goods, from electronics to clothing to machinery. This wasn't exactly a bolt from the blue. The Trump administration had been threatening tariffs on Chinese goods for months, citing concerns about unfair trade practices, intellectual property theft, and a massive trade deficit. China, of course, wasn't too thrilled about this. They accused the US of protectionism and threatened to retaliate with tariffs of their own on American goods. And that, my friends, is how a trade war is born. Wall Street feels the tremors. You know things are getting serious when the stock market starts freaking out. And freak out it did when the news of the tariffs hit. The Dow Jones Industrial Average, that big, scary index that tracks the performance of 30 major American companies, took a nosedive. Investors, worried about the impact of the tariffs on corporate profits, started selling off stocks like they were going out of style. It wasn't just the big boys on Wall Street who felt the pain. Small businesses that rely on imports from China also started feeling the squeeze. Higher tariffs meant higher costs. And those costs often got passed down to consumers in the form of higher prices. From iPhones to algorithms. Tech takes a hit from iPhones to algorithms. The tech industry, which relies heavily on China for manufacturing and supply chains, was hit particularly hard by the tariffs. Apple, the maker of your beloved iPhones and MacBooks, saw its stock price take a tumble. Why? Because a big chunk of their manufacturing happens in China, and those tariffs made their products more expensive to produce. But it wasn't just Apple. Chipmakers like Nvidia and Intel, which supply the brains for our computers and smartphones, also felt the heat. They rely on China for both manufacturing and as a massive market for their products. The tariffs messed with their supply chains and threatened to dampen demand for their products in China. A cascade of consequences. The tech sector wasn't the only one feeling the burn. The tariffs had a ripple effect throughout the US economy, impacting everything from retail to agriculture to manufacturing. Retailers, facing higher prices for imported goods, had to make some tough choices. Some decided to eat the costs, while others raised prices for consumers. Either way, it put a strain on their businesses. Farmers, already reeling from low commodity prices, got hit with retaliatory tariffs from China on American agricultural products like soybeans and pork. This made it harder for them to sell their products overseas and put a further dent in their incomes. And let's not forget about manufacturers. Many American companies rely on parts and materials sourced from China. The tariffs made those inputs more expensive, forcing some companies to raise prices or even move their manufacturing operations elsewhere. The why behind the tariff walls. So, why did President Trump decide to go down this tariff-laden path? The decision was not made lightly and was rooted in a series of complex economic and political considerations. Well, he argued that it was all about protecting American jobs and businesses from what he saw as unfair trade practices by China. The administration believed that these practices were putting American workers at a significant disadvantage. He accused China of stealing American intellectual property, a claim that has been echoed by many in the tech and manufacturing sectors. This theft, according to Trump, was costing the U.S. economy billions of dollars each year. Forcing technology transfers from American companies, which meant that U.S. firms had to share their innovations and trade secrets just to do business in China. This was seen as a direct threat to American competitiveness. And manipulating its currency to give its exports an unfair advantage. By keeping the value of the yuan low, China could make its goods cheaper on the global market, undercutting American products. He also pointed to the massive trade deficit between the U.S. and China, which he saw as evidence of an imbalanced and unfair trading relationship. The U.S. was importing far more from China than it was exporting, arguing that China was selling far more to the U.S. than it was buying. This, he claimed, was draining American wealth and harming domestic industries. The tariffs, he argued, were a way to level the playing field and force China to change its ways. By imposing these tariffs, the administration hoped to pressure China into adopting fairer trade practices. Of course, not everyone bought into this argument. Many economists and business leaders were skeptical of the effectiveness of tariffs as a tool for achieving these goals. Critics argued that the tariffs were more likely to hurt American businesses and consumers than they were to change China's behavior. They warned that the costs of these tariffs would ultimately be passed on to American consumers in the form of higher prices. They also pointed out that tariffs are a blunt instrument that could lead to unintended consequences, such as disrupting global supply chains and sparking retaliatory measures from other countries, like higher prices and job losses in the U.S. The debate over the tariffs highlighted the complexities of global trade and the challenges of protecting domestic industries in an interconnected world. The global backlash. As you might expect, China wasn't about to take these tariffs lying down. They fired back with retaliatory tariffs of their own on a range of American goods, from soybeans and pork to cars and chemicals. This tit-for-tat tariff battle escalated quickly, with both sides digging in their heels and refusing to back down. The trade war between the US and China sent shockwaves throughout the global economy. Other countries, caught in the crossfire, worried about the impact on their own economies. Some countries, like the European Union, even threatened to impose their own retaliatory tariffs on American goods. The uncertain future of trade in a tariffed world. So, what's the takeaway from this whole tariff saga? Well, one thing's for sure, the global trading system, which has been built on decades of cooperation and liberalization, is facing its biggest challenge in a long time. The trade war between the US and China has created uncertainty and volatility in the global economy. It has also raised serious questions about the future of globalization and the rules-based trading order that has governed international commerce for decades. Will the US and China eventually reach a trade deal that addresses their differences? Or will this trade war escalate further, leading to a full-blown trade war that could plunge the global economy into recession? Only time will tell. But one thing's for sure, the stakes are high, and the world is watching.